Did you know that the average rental price in Hawaii has increased by over 11% in 3 years? This is a golden opportunity for investors, but only if you know how to analyze properties correctly. Today, we're diving into how you can effectively analyze a rental property in Hawaii, especially if you're just starting out. Understanding how to do this right is crucial if you're aiming for a profitable investment here in Paradise. The Hawaii rental market can be complex with its mix of tourist hotspots, local demand, and seasonal fluctuation. But it also presents huge opportunities if you approach it with the right knowledge and strategies. Stick around and I'll make sure you know exactly what to look for before making your next move. Now, if you're a beginner, I know the process of analyzing rental properties can seem overwhelming. Where do you find reliable data? How do you gauge market trends or even calculate your returns? Hawaii has its own unique dynamics, and if you don't understand them, it's easy to make costly mistakes. You need to consider the local economy, seasonality due to tourism, and even factors like zoning laws and local regulations that can affect short-term rental opportunities. But don't worry, I'm here to help you break it all down into manageable steps. By the end of this video, you'll have a solid framework that will make analyzing rental properties much less intimidating and much more achievable. First, let's talk about location. In Hawaii, where your property is situated makes a huge difference, not just between islands, but even between neighborhoods. Rental demand varies significantly, and understanding the balance between tourist zone and local residential areas is key to make the right investment. For example, a property in Waikiki may have strong appeal for tourists and short-term rentals, whereas a property in a more residential area, like Mililani, might be better suited for long-term leases to local families. The location will determine not only the rental demand, but also the kind of tenants you're likely to attract and the rent you can command. Do thorough research into local amenities, schools, shopping areas, and the overall vibe of the neighborhood. It's also important to understand the local community. You want a property that not only draws in tenants, but keeps them happy, so they stay for the long term. Next, think about the property condition. Is it move-in ready or does it need renovations? Fixer-uppers can offer great returns, but only if you're prepared for the work involved. Renovations can be both time-consuming and costly, but they also provide an opportunity to add significant value to your investment. Properties that need work might deter some investors, but for those willing to take on the challenge, there's often a great upside. If you go this route, make sure to budget properly for the renovations, both in terms of cost and time. It's also a good idea to consider whether you have the right network of contractors or property managers who can help you through this process smoothly. Hawaii is unique in terms of climate. Materials can wear down faster due to humidity, salt air, and other environmental factors. But keep that in mind when calculating your costs. Then, there's the all-important rental demand. Hawaii's market can shift based on tourist seasons, economic changes, and even international travel policies, as we've seen during the pandemic. Look into vacancy rates in your area and understand your target renter, whether it's local families, military personnel, or vacationers on extended stays. Who you are renting to will determine how you market the property and what features are most important to include. Are you furnishing for short-term guests, or are you looking to create a comfortable long-term family home? Understanding your audience will make your property more attractive and minimize vacancy periods. Additionally, keeping an eye on market reports and economic news relevant to Hawaii can provide insights into how rental demand might evolve into the future. Lastly, let's not forget about the numbers. Calculating your cash flow and return on investment is essential. Make sure you're considering all costs: mortgage, insurance, property taxes, potential HOA fees, and don't forget property management fees if you're not planning to self-manage. These costs can add up quickly, and it's important to have an accurate picture before diving in. In Hawaii, there are additional considerations like hurricane insurance and potentially higher property taxes depending on the location and zoning. Be diligent in your analysis to ensure your investment makes sense financially, even after factoring in these extra costs. Now, if you're feeling a bit lost, don't worry. There are tools out there to help simplify the analysis process. One of my favorites is the Bigger Pockets Rental Property Analysis tool. I'll put a link in the description below. It walks you through every factor from rental income, expenses, potential cash flow, and even appreciation. Using this tool can give you a clearer picture and make sure that you're not missing anything critical in your analysis. For anyone serious about investing in rental properties, I highly recommend checking it out and plugging in the numbers to see how your potential property stacks up. Let's talk about the rent-to-price ratio, one of the key metrics investors use to analyze rental properties. Typically, to generate positive cash flow, you want a rent-to-price ratio of about 1%. But here's the catch. On Oahu, hitting the 1% target with a long-term rental is nearly impossible. You might get closer to it on the Big Island, but it's still challenging. So, if you want to improve that debt ratio on an Oahu rental, consider shifting gears. One option is running the property as a mid-term rental. That means renting for 30 days or more to traveling nurses, remote workers, or anyone needing temporary housing. Mid-term rentals can often generate more rent than typical long-term leases, pushing your rental price ratio into a more favorable range. Now, it's important to remember that cash flow is just one part of the equation. The real secret to building wealth on Oahu is appreciation. This is where most investors truly benefit. Appreciation varies widely, depending on the neighborhood, and is notoriously hard to pin down. But let me share some recent numbers. As of September 2024, the median price for a single-family home on Oahu increased by 7%, reaching $1.225 million, while condo prices dropped by 3%, selling at $515,000. Personally, I don't underwrite with appreciation as a guarantee because it's just too unpredictable. But the long-term supply and demand dynamics here point to a consistent upward trend in home values. With limited land and strong demand for living in paradise, appreciation is one of the biggest wealth builders for Oahu investors. So yes, achieving cash flow on Oahu can be tough, but with a smart strategy, there's still a lot of opportunity for growth. So, to summarize, thoroughly analyzing rental properties in Hawaii involves understanding location dynamics, rental demand, property condition, and of course, running the numbers to determine the cash flow and ROI. Remember, it's not just about buying a property, it's about buying the right property. Location is crucial. Understanding who your renters will be is key, and making sure the financials add up is non-negotiable. Investing in Hawaii can be incredibly rewarding, but only if you're diligent in your analysis and planning. If you found this video helpful, drop a comment below with your thoughts on rental property analysis or any questions you have. I'd love to hear from you, and make sure to subscribe so you don't miss my weekly videos.